Look, it's actually been quite a good year, and that all you had to do was get the big calls right. So January you had to be long on treasuries. In March on the sell-off, you moved into gold and into equities. The difficulty on the everything rally that we had was that everything then started to look expensive, and so we were actually building up pretty big cash positions, taking a bit of everything off the table because everything was looking expensive. What happened in the last few weeks actually has been really helpful for us, and that we've been able to rebuild treasury positions because long treasuries certainly have sold off. And again, we think on the basis that people didn't understand the Fed message. I'm not saying we understood it, but I don't think anybody else understood it, and they sold long treasuries. So for the last couple of weeks, there's been a real chance to build up those long treasury positions again to a decent size. But I think skepticism, hold cash, and do what we always do, which is scenario plan. Look what can happen. How far can the markets fall? What can happen to tech? How far can Tesla fall? You've got to look at all these things and have a plan ready for when they do. And right now, with everything being relatively expensive, that plan is telling us to be overweight cash more than anything.
Interesting, Paul, that you haven't mentioned gold. Just update us. What's the current view? I mean, if you look at the miners, the gold miners are kind of treading water, trading sideways.
So we built up. We had a gold position coming into the year. We built that up to around about 20% of portfolios in a lot of the advisory portfolios across different risk levels, around 20%. But we took a lot of that off the table when gold got up to 2050. That was again just looking expensive. We were hoping to buy back much cheaper. So far, we've only been able to really nibble. We haven't seen the sort of prices where we think gold is compelling. So it's between 5 to 10% of portfolios now as a hedge, and it's primarily in gold because the miners again just seem to get too far ahead of themselves. So we came out of the position in miners probably a bit early, but we came out of that because they were looking expensive relative to bullion itself. So right now, bullion looks better than miners. It looks a reasonable bet in a very expensive market.